to the. All
Hey,
right,
Peter.
we are now live. Hello.
Hey guys.
Hey, Peter.
All right.
Hey, Peter.
Yeah, I think we'll. Yeah, we're just waiting for a few more folks to join us. We'll probably start at 6:03.
Good. I'll keep working.
That's right. Keep
My
working on the
notes.
charts. Great job, by the way, guys.
Yeah, this is great.
Yeah.
I think this was a lighter 2 weeks than maybe the first go around. There seems to be maybe lesser, but maybe even bigger hitting items in the government, I guess. But we're kind of acclimating a little bit, so it's less groundbreaking new surprises. It's more
That's
like, okay,
true.
let's modify this a little bit.
Yeah.
So, good news. So
that's true. Definitely good news around the corner. Cases coming down a bit.
Mm-hmm.
Yeah. I can't wait to hear about opening America.
Yeah, it's we'll see how that goes.
Stay home a little too long.
Implementation is different than theory. So.
That's right. Getting a little cabin fever. But today, when I go out to go do some grocery shopping, I see there are a lot more people, more cars in the parking lot, and definitely the mood is changing.
Oh, hey, apparently our chatter is being heard on the webinar.
Oh, what's that? What's that?
So our conversation is like, there are people that are on the webinar right now.
Yeah, it's live. We're live.
We're live.
Yes, we're just waiting for, I think we have pretty much everyone on the panelists. Yeah, Yan is here. Hey, Yan.
I think she's just joined it. There's
she just joined. And everybody on the audience, we will be starting very soon. Feel free to use the chat box to tell us where you're from, and we'll get going pretty soon. And even Chuck made it today. All right, Chuck from Tampa. Hi, Chuck.
I'm doing good. I'm going to mute myself, though, so I can listen in and you don't hear a bunch of background.
All right. Hearing you sipping wine or beer is late over you.
Actually, it's an energy drink. Try and stay awake out here.
That's right. Wow. You sound like a millennials. Like an energy drinks.
There you go.
You have so much energy. All right.
I don't know, man. All right. Well, hi. I'll turn off my my mic and listen in.
Awesome. All right. So I think we do have everyone on the panel. I think we can go ahead and get started. And I think Yan is on mute, so I think everybody's here. Awesome. Let me turn on my presentation mode. And let's see. 5 words. All right, it does. All right, hello everybody. Well, welcome to our 5th webinar series, and we are the Coast-to-Coast Multifamily U chapters. We have the panelists, including myself, are past graduates of the Multifamily U, and so we are just gathering the groups from across the U.S. To co-host this webinar, and we are going to be talking about the impact of COVID to real estate and economy. So we're gathering news and webinars that go on for the last week and a week and a half, summarize and distill information, and hopefully we can add some value by sharing and helping each other to learn and grow together. All right, so just first give a promo to Multifamily U. You can go into their website and they have lots of no-fluff data-focused webinars, interview with different guests, CPAs and lawyers, and they also have a great course on locations, finding the right place to invest. Neil does a really good job of all these hands-on tools to help select real estate markets for your next investment. It looks like he just put up to a apartment analyzer tool to help with underwriting. And it looks like Neil's also doing a boot camp, which I was a student of, which I learned quite a bit about syndication, just investments, lots of good stuff there. And that's going to be an e-boot camp sometime in June. And so in one of those boot camp, I met a lot of the panelists here on the call, and also maybe some of you in the audience as well. So also they just did another webinar on just coronavirus impact, and they had invited brokers and lender as well. And actually, Vivek will be sharing with us what he learned from that webinar. So you can go onto their Facebook or their website to see what's the next webinar coming up. With that, I wanted to introduce or let everyone introduce themselves, and I'll get started. I'm Henry Yoon. I'm from Seattle, I'm dad of 2 kids, and I am an aerospace engineer by training, and been involved in real estate. I have my little single family portfolio and been done some wholesaling, fix and flip, some development. And I just right now focus in multifamily. So with that, let's go around clockwise and let's go to Yen.
Hi, my name is Yen. I'm from New York, New Jersey. I work for a hedge fund. My strength is quantitative analysis. I found multifamily is very interesting, a lot of data to analyze. So hopefully we can all learn from each other. Thanks.
Awesome. Chuck, you want to go next?
Sure. My name is Chuck Long. I come from a health care background. I've been a dentist for a bunch of years and did some single family homes out in California. And now I'm with this great group branching out into some multifamily.
Awesome, Chuck. James?
Hey everybody, this is James from Orange County, Los Angeles area. I am a chemical engineer. I currently work for the government, so I'd probably be the last to be laid off, fortunately. I've been in real estate for about 3 years now, give or take, working on single families in the beginning, but then ultimately transitioning heavily into commercial real estate and multifamily with a strong focus the last year. And just always learning and growing and connecting with people, and these things are probably my favorite part of my day. So glad to be here.
Yeah, same here. Hey, Peter.
Hey, so Peter Pomeroy from San Francisco, grew up here, and I've been in real estate for over 20 years in a bunch of different capacities: construction, as a broker for Colliers, development and investment in different product types, office, industrial, land, and have been focusing in on multifamily for the last few years. And it's great to be on these calls. Always learn a ton. So,
all right, thanks, Peter. Bowick?
Oh, hi. This is Bowick, Washington, Bellevue. So I'm a certified real estate instructor and investor, and also in title industry too.
Oh yeah, if you need title issues, Bowick will solve for you. Ujay.
Hi, my name is Wujay Kim. I'm a physician in Los Angeles area, and I've been involved in real estate for the past 4 or 5 years. Just mainly focused on investing in single house flipping projects, but my interest has turned to multifamily, and then in the process, I met all these great people. I'm learning a lot in the journey, and want to welcome all of you guys to join the journey.
All right, thank you, Dr. Kim. Vivek.
Hey everyone, this is Vivek Arza from San Jose, California. I'm a daytime electrical engineer, but I got started in real estate and have a single family portfolio out of state. Been doing that for about 2 years now. I live with my wife and young daughter in San Jose. Looking to scale into multifamily and also different classes of real estate on the commercial side. Great learning from all of you on the call, and glad to be part of it.
Awesome. Yes, and for the audience, feel free to use the chat box and the Q&A. And if you also wanted to talk, you can use the raise your hand button, and we'll let you speak then as well. And here is contact information. Here you can find us by this email address. And I just created a Facebook group just maybe 10 minutes before the call. So it's still in construction, but you can find us. Actually, we have a Facebook presence, and I'll be announcing future events there as well. And we'll come back to the contact information at the end of the chart. All right, so here is the agenda for today. I kind of break it up into two sections. The first being the economy, and the second is real estate. And James will be talking about opening America. I'll share some macro data as well. And Peter is going to talk about the 3 possible economic outcomes. And then the real estate section, we'll start with James talking about the Yardi matrix, and Vivek will be talking about the Go Capitalist Town Hall 3 meeting, which will have a lender and a broker, and Ujay will be talking about the residential lending options that are currently available for single home buyer, and I'll be adding what's happening in the commercial side for apartments, and also what valuation might look like in the near future. And then Boet will wrap us up with what's going on in the residential housing and closing. It'll be interesting to hear what he has to say there. So with that, we can get started with the economy. Go ahead, James.
Thank you, Henry. So this is I'm calling this the legislative light at the end of the tunnel, but it's still a very faint light. Some of you may have heard the White House's guidelines given to the governors of each state made last week. And but as we'll see in the other slides, there's still very mixed data about what's actually going to happen in the upcoming weeks and months. Over the last week, we've seen a number of protests across the country. One was in my backyard. So that was interesting to see. But what we'd like to do really, if we can't predict, we'd like to observe history as well as educated data-backed guesses on what the trends are going to lead into. So we are coming to a tipping point where we're beginning to really see the economic pain that is more so experienced than others, and that's becoming the question is the cure worse than the disease? And it actually is a disease in this case. So is the hardship justifying the reduced healthcare risk? So the president has actually, President Trump has actually supported the intent, and I emphasize intent of these protests, as he does seem to understand the dire and pressing need of the economic livelihood for the really millions of people that are unemployed or at least employed but struggling. And as I mentioned, these correspondingly, the White House administration did release guidelines for both a strategic and a staged economic lifting of restrictions, which is dubbed the guidelines for, and given it's Trump, it has to have America again in it, but opening up America again. And this is not necessarily a black and white requirement, but it is guidelines, but it is it should be a requirement, but it's a 3-phase plan for each governor to implement. Essentially going to where we are now, which is either lockdown or very severe quarantine, to progressive lessening or loosening of those things, to resume travel or to visit nursing care facilities. The caveat is that in order to go from where we are now to stage 1 to stage 2 to phase 3 is 2 things need to happen, namely 14-day declines in number of new cases, as well as allow hospital capacity being able to operate in quote unquote normal mode without being in crisis care, which is just a heightened state of emergency in these hospitals that many are experiencing. And as well as a testing and contact tracing, which is probably in my opinion, the least progressed element of this plan. The testing plans are really unknown on the state level. So some have put out guidelines recently about, yes, we have enough testing capacity, some don't. So, and some have announced plans. So it's really open in the air, but this is at least a step in the right direction. And hopefully this is followed and we can actually experience these lessenings of these restrictions. So that's the start off on a positive note, but now we'll look into some actually a little bit more hard data numbers in the subsequent slides. So go ahead and take away.
Well, thanks, James. Yeah, definitely. I think that's the hope for the country to reopen the economy. This is a great lead in because when you mentioned a little bit about looking across history and looking at also what other countries are doing, and that's what I wanted to share with us, everybody. But before we get to that point, I also want to share kind of the economic kind of situation we're in. And I brought this chart from Hedge Eye, which is a hedge fund, and they provide some timely update on the data regarding businesses and household. And this is the chart showing that on the left side is how long can a small business survive a shutdown, and it also horizontally show how many months. It might be survey data. I'm not exactly sure how they collect this information, but it looks like there's about 20% of small business cannot withstand in a 1 month shutdown, and we're pretty close to that point. I know the government is definitely doing something to help with some of the small business administration loans and things like that, but there's a lot of businesses that aren't getting that, especially the smaller businesses. I mean, we heard story of Shake Shack and other bigger small business. They're getting funding first, but not the mom and pop. So we're definitely concerned. That's one reason why I think the president really wants to open up America. At the same time, for the household, there's about 50%. I mean, you might heard of that in the news where not a lot of people have savings. And this is what this chart showing by age group, but in aggregate level, there's about half of the household don't have any emergency saving. So I think the checks are now being, I think some people said they have the checks already, either directly deposited into their bank or getting the checks. So that's helpful. And hopefully they can keep that going until we open this up again. So this chart is talking about how the countries are doing, and this is a case happened in Hong Kong. It's actually an outdated chart. It's happening in March 25th, but they were one of the countries that were really aggressive up front. They didn't really have a community outbreak, and in the beginning of February, since they were closest to China, they have some cases, and they in the beginning they have about 100 cases, and they start since they had the first SARS one, people know how to deal with a virus like this. So people are wearing masks, and everyone's basically trying to quarantine themselves or be extra, hand washing and all of that. So they were able to control cases, especially for February through March. And then you can see they start going back to work in about beginning of March. So this is kind of their opening up. And as you can see, they see a huge increase up to actually about 300 as the cases around kind of late March. And now they had to go back and basically have to go back and work from home again. So you can see that there could be a second wave, so to speak. And this is for a city which very aggressive, do testings, do contact tracing, and they still have a second wave. So it might be a situation that U.S. would have to face if we're opening up too early. And they basically opens it up at about 300 cases. So I mean 100 cases. So right now, every day we still have 2,000 cases kind of in America. So I think it's not as easy as we hope. And this is again just to show kind of how the mobility data from Google, so people's report on their phone, Google is picking up where the GPS is and kind of see whether people are really being in lockdown or they're still moving around. And Italy and France, as you all know, the situation is really dire, and the city or the country went to shut down. It was complete lockdown. I mean, these are smaller countries, and U.S. and Brazil are much bigger geographically, and so there's still a lot more movements, and you can kind of see that the case. I mean, Americans are still going to parks, and it's less transit, but they're still a large compared to the other countries. We're not as locked down, so we might still have an issue where we have countries that are getting a lot better, and then states that are doing a lot better versus other states who might not, and there might be people moving even between different cities and states. that makes it really hard to I think if each state has their own approach on the opening up. I think that's the last one I want to talk about regarding opening up. And so then I wanted to give to Peter to talk about the 3 possible economic outcomes.
Thanks, Henry. So this information comes from Kathy Fettke, who with her husband, they run, what is it called? The Real Wealth Network. And it was a really one webinar kind of cut up into 3 YouTube videos. Really very interesting. So what I wanted to do is first to give context to how we might emerge from this, go back and look at kind of where we were in 2008. So when you see those red, and I know you can't really see these charts, but the key thing is seeing the lines. And those red arrows pointing up show where we were in the 2008 recession. And let's see. So first, kind of key points here is that the U.S.'s growth is fueled in large part by the Fed pumping money into the economy. The fancy term for that is called quantitative easing. But again, that's just the Fed, creating and distributing money and putting it into our economy. And as you'll see, it works, but it also creates debt. Some of that debt is good debt, and some of that debt is less good debt. Let's just keep it real simple. And by good debt, I mean debt that is used for growth. So in real estate, we use debt as leverage, and that's for growth, and usually that's good unless you're over leveraged. But in the slide on the right, what you'll see is that while the GDP is skyrocketed, or on the left, let's just start there. The GDP has gone up, so is the national debt. And on the right, you'll see the ratio of debt to GDP has really bounced way up from 2008 to where we are now. So what we're seeing is that a lot of our GDP growth has been dependent on debt. And so when we're calling, a strong economy, it's really based on that debt, which creates a potentially precarious situation. So if you go to the next slide, Henry. I've got two sets of slides, so mine didn't move automatically. Okay, perfect. So here, on the left, you'll see 2 slides, the stock market and the housing markets. And a couple things. When the Fed puts money into, through stimulus, interest rates, et cetera, into the economy, what happens is the stock market goes up, the housing market goes up, and Americans are happy. But what has also been noticed is on the right, the economy has started to slow really in 2019 and progressively slowed. And so you have this disequilibrium between a highlighted strong stock market, a strong housing market, but a slowing economy, which kind of primes the US for a recession. And there were some people, and they weren't getting a lot of audience. They weren't getting a lot of attention that, hey, things are out of whack. Now some people were, but by January 2020, a lot of people were saying, okay, there's going to be some sort of correction. And in some markets, like say San Francisco or the Bay Area, the brokers I know who sell multifamily and commercial were like, well, the party's going to end, so I got to really hustle right now, get as much business done as possible in anticipation of a slowdown. Whereas in other markets like, North Carolina and, obviously parts of Texas, et cetera, there was continued growth, but there was this disequilibrium. and we were primed for a recession, and hence you see there's that black swan, and nobody could anticipate that our recession would be triggered by a virus, which kind of, I think, obviously really put us on our heels. So I think that there's a couple questions to consider, and really the second question is the most important one. But if we had right now a growing and then healthy economy that had a better kind of debt to GDP makeup, what kind of difference would that have made, both in terms of how we're sitting right now? And I don't know that it would have made a big difference in terms of how we're sitting right now, because I think we're in like, triage mode where we're just trying to, figure out how to take care of people, etc. But maybe more importantly is, if we had a healthy growing economy, how would that factor into and impact how we will emerge from this recession, both as a country and economically? So, keep that in mind, as we look at these next three slides, and, as the days, continue to go by. And so now we'll look at Kathy Fettke's kind of, three different scenarios. So the first scenario, which is the V, which, I think a lot of people, really want, is, where we're, it's 8 to 10 months, there's this, big drop, obviously, and then a big bounce back. And if you believe that's the case, then, depending on who you talk to, you want to be buying properties, within, say, 4 months, and there'll be a discount. It may not be dramatic. It may not be broad. And by that I mean like kind of across the country, across all products. It might be more selective, but nonetheless, there'll be some sort of discount. But what's dependent on that is that Americans, get their stimulus checks, that they get their unemployment checks, that small businesses get their PPP loans. And, one of the challenges that I'm hearing, and I'm sure many of you are, is that, people are having trouble getting their checks, and actually there's not enough money for the checks. And, I don't know, I'm just stating the facts. That's what I'm hearing. And maybe the government isn't, to be maybe a little fair to the government, they haven't experienced this amount of sudden unemployment so dramatically all at once, and so they're not really prepared to mobilize. But nonetheless, it's important that people get those checks, because those checks mean they can pay their bills. They can basically stay afloat, whether it's a small business or an individual. And then when we emerge out of the V, they can be employed again, and we can resume some type of new normal that is closer to what we experienced before. Okay, so the analogy, historic example, is to the S&L recession, and we don't need to touch on that, other than it's just really an illustration that we've had a V recession in the past. So with that, we can go to the next one. Okay, so less desirable is the U recession. And in this instance, it's longer, it's 16 months, plus or minus. We're kind of bouncing on the bottom. And in this instance, companies and cities too start to take on more and more debt to survive. And I thought it was interesting that Kathy used the word survive. The disease is not controlled. Now, she didn't define what that means, but nonetheless. And then, a third component was there are mental scars, which I think there will be, my personal opinion, where people are just afraid to go back out and do normal things like fly and go to conferences. But, then again, maybe people adopt adapt to masks, etc. But that just slows the economy. Another consideration is how what happens to cities. So they'll take on debt to support their services. And right now we're seeing in cities like Las Vegas, I've heard that they're having to lay off police force because they can't afford to pay them. Now that may make sense for Las Vegas, and it's kind of like an extreme example, but there's a trickle down effect. So Las Vegas obviously dependent on all the tourism, and if that's just not happening, which it's not, it's going to be impacted. But I think that that will trickle down, and many other cities will experience that in their own way. So and with the U, there's a bigger discount to real estate, as you can imagine, right? So there are a lot of real estate investors that are kind of probably hoping for a U, because there you're going to see more of a kind of broad-based discount, and people that own real estate are going to be in a lot more trouble. And also in a U-shaped scenario, the global supply chains and global economies and their interdependencies start to be impacted, which just creates for more kind of trauma and difficulty. So not good. So the historic examples in the early 70s, and I remember as like a little kid, really small, the long gas lines, but I think this would be altogether pretty different. But nonetheless, the illustration is of note because it's it was long and we bounced on the bottom for a while. All right, so let's go to the hopefully least probable and least desirable one, which is the L, which is basically a recession where the government cannot, where the governmental policies, the Fed, etc., we can't get out of the recession, and then it becomes a depression. And I think that a lot of people, well, I don't know, but I'm not hearing, too many people saying, oh, it's going to be a depression. And I have to say, I used to be kind of bullish on most of everything in life, and I'm turning into more of a bear. So I think I might be hearing more of this, but who knows? But for, a few key things have to happen for this to happen. But the overall thesis, again, is that the recession is so bad the U.S. can't pull itself out of it. But again, the vast majority of cities, or not again, but the vast majority of cities and companies, they start to really, really rely on debt. And there's this terrible cycle. But then they can't pay the debt back, which makes it harder to get more debt. And, things just kind of spiral. Global economies start to suffer. And as I said before, the U.S. economic policies are no longer effective. And the effect is that we're really bouncing on the bottom for a longer period of time. So I put a chunky image here, and that's in the black frame. That's a crystal ball, and nobody has a crystal ball. But I think the two slides at the front that give a little context to where we were, let's say January 2020. And also, I mean, if you really want to go back, it was really great in her webinar. She went all the way back to like when the Fed was created, and its purpose is to stimulate our economy with cash, basically. And periodically there's corrections, but we're, we were set up for a recession January 2020. And, nobody knows, the thing with a recession is no one ever is, kind of like anticipates it too much. And then this recession was triggered by a virus, which was a big surprise. So how we will emerge, I think, in large part, has a lot to do with where we were January 2020. So with that, I'll pass it on.
Thanks, Peter. That's a lot of knowledge there. Awesome charts. By the way, my guess is a W.
I don't even, yeah.
Call it whatever shape you want. Or Nike swoosh.
I think if it's a W, then it's going to be a V with a U.
That's right. Awesome. Well, thank you for that. So we're now going to jump into real estate. We're going to start with James.
Yeah, thank you, Henry. Let me switch over. I do have quite a bit here, and that's because the Yardi Matrix had quite a bit. Yardi Matrix is one of the industry leaders in commercial real estate intelligence data, so naturally they have a lot of charts and graphs and things. So it was really very educational and really holistic in getting a pulse on the industry as a whole. So I'm only going to be, with that being said, I'm only going to be covering a few of the key points. If there's any questions about any specific of these points, I'll be free to message me later, and I'll explain in a little bit more detail. But just as a brief touch and tie into the disease itself, they were talking about a few models because it does tie into the industry as a whole, because real estate is unique in its ability to weather, in my opinion, recessions. But multiple models are currently circulating out there, various universities, various data analytics firms, but it really ranges between mid-April. Obviously, it's mid-April now, but obviously we're not done yet. So it's probably going to be, which is their opinion as well, mid to late May. With that being said, maybe I'm the hopeful person, but they did really bring to light the fact that there's nearly 90 drugs currently being tested. They're existing drugs, granted, but there's a lot of effort being, especially with the stimulus bill that was actually just approved today, I believe, that would provide additional funds for hospitals and research. So it was great to hear as well. So now transitioning into real estate, there are some national responses at play on the debt side. Fannie and Freddie Mae, the government-sponsored agency departments, they are allowing for loan deferments for COVID-related causes of non-performance, but with the caveat that they don't likewise evict those same tenants. So kind of like what we're seeing in some jurisdictions, which you can see in the table below. Pretty much all saying the same thing, just don't evict your people. So, which is also the advisement of the National Multifamily Housing Council as well, which is becoming the de facto data source for a lot of operators and industry professionals. So on the next slide, just a kind of a recap of kind of what we went over last week. And they're trying to do like a granular approach to seeing like, what is this effect on real estate, but also real estate's part of the economy as well. So they gave an example of kind of what the average unemployment benefit was and what the stimulus is going to be doing. And really, essentially, there shouldn't be, provided there's no extenuating circumstances, there shouldn't be a problem for people covering at least the basic necessities, of which is a component is rent. So there's a case that can be made that we will see maybe a similar trend that we did for April that we'll see in May for the rent collections throughout, maybe not necessarily at the beginning of the month, but throughout the month, certainly. And as we, panelists and I were discussing earlier about some of the large companies taking up the small business designated loans. So that's definitely an interesting news bit. And that was also with the news today, there's a second series of loans for small businesses. But the key thing though is, yes, there can be funds, but the key thing, at least in terms of recovery, is bankruptcies, because if you're not a business, you can't rehire your people. Granted, there's a lot of other factors, but so I was interested in like, okay, what are we actually seeing more bankruptcies? And so I went to the American Bankruptcy Institute and I looked at several months of data comparing their month over month and year over year change, and the data is there, very simplified form, of course, but really we're not seeing too much of a difference from what we would see on a normal year. So that's great news. We'll see how April turns out, because that was the first month of like full month, at least, of like really experiencing the economic hardship. So on our next webinar, I'll definitely give you an updated chart and we'll see if this 0, 1, -5 kind of holds true for the month of April. So on the next slide. So this was an interesting kind of a data point that they were providing, and They're predicting there is a disproportionate economic impact on maybe not necessarily real estate, but just businesses in general. We're seeing a disproportionate impact on hourly employees who make up a large portion of specific industries like retail, fast food, things of that nature, hotels. So they, but conversely, some of those industries may have what I'm calling a shorter customer cycle, wherein it's a short time frame to get someone to really complete the transaction, if you will, as opposed to like hotels where you need to schedule in advance with your corporation or your business and plan your travel and your flights and all these things. So whereas with the restaurant, yeah, let's go out to eat tonight. Yeah. And it's over in a few hours. So so it's going to be interesting to see how the bounce back might differ in that, whether it's a V, whether it's a U that Peter was talking about. But I think the letters may be a little bit larger or smaller depending on the industry. So we'll see how that works out. So like I said, again, we're just looking at trends and we're kind of really keeping a close eye day by day on these things. So on the next slide. Now this is real estate specific. Yardi is a data conglomerate. So they have a lot of data and they actually own a website, which some of you may have heard of or even used. It's called Rent Cafe, a very large website with a large user base. They're seeing nationally, of course, you have to take a national statistic with a really big grain of salt because everything in real estate is hyper local, as Neil Bawa would say, hyper local. But overall, as on a national basis, we're about a 20% decline in listing viewings. And as you can see, what I just said, there's a large disparity. Some are having higher viewings, some are having very much lower listings, such as Pittsburgh and Denver. They're experiencing lower call volume. And what seems to be a point of not controversy, but more like kind of some people are saying one thing, some people are saying another, is which class of apartments is actually going to fare, maybe not well, but better. Class A, Class B, or Class C. What I took of it, and maybe I'm interpreting it correctly, but how I read the data was that Class C is being more steady Eddie, not having a lot of evictions, but also not having a lot of available units from turnovers or people leaving. So whereas a Class A, which is, I'm not sure if you can see it too well, but the darker line, they're kind of on the extremes of those two parameters. So that's interesting. Whereas Kathy Feke in her webinar that Peter mentioned, she's kind of arguing for the opposite. That Class C is just different parameters. Class C may have they're part of that hourly employee, so they're going to have a brunt of the impact. Whereas Class A tenants have more of intellectual capital, where they may be, there's actually already saying intellectual capital. Class A tenants may be able to work from home and thus not experiencing any rent payment delinquency. So it's very interesting, just different people having different opinions, and it just bolsters the point of no one really knows, but we're trying to make educated guesses based on the trends. And on the next slide. Oh, I think we may have skipped. Yeah, there we go. Yeah, right here. So this was a survey made by Newmark Knight Frank, which is a very large real estate services firm. They do a lot of things, more than this slide could hold. But they asked their large company, they have a lot of professionals that work for them, what they're seeing in terms of their activities and acquisitions and dispositions, and also the performance of the real estate. But essentially, people aren't doing the movement pieces, the traveling to the site, the inspections, but they're still going to buying properties. There's a little bit of a more holding on. They're not necessarily selling. Maybe they're waiting for the market to see what's going to do. We're going into contract on a deal today, so we're still in acquisition. Obviously, that seller wanted to get out as soon as possible, but some sellers actually pulled out on deals we looked at. So it's really case by case. And I believe I have 2 more slides. I'll just go for the next one very quickly. But Yardi Matrix is actually having a webinar dedicated to delving into each of these. But this is just kind of like a playbook. They're calling it their playbook for operators. Things that you should at least heavily consider doing to either minimize your impact to your property's performance or minimize the impact to your tenants, which really go hand in hand. So just a good checklist of things to keep in mind as you asset manage your property. on our next slide. And what many of you may have known is Yardi's fantastic reports that they send out. I believe it's quarterly, maybe it's monthly actually, but with their rent projections, and they are the go-to source for this. And these things were, the numbers you see here are assuming no one has, if you looked at my previous slide with the rent freezes, if no one freezes the rents. So if everyone tries to decrease the rents to try to generate that demand, but what we're seeing is not a rent price sensitivity, it's more of a socio kind of cause of people not actually moving, as we saw in the listing slide. But what I found most interesting here actually is Las Vegas and Phoenix, top rental markets in the country, past 5 years, 7% rent growth, but they're actually gonna see a pretty significant decline, not unlike the Great Recession, but this is for a different reason. But it varies in terms of how much they bounce back. But there is a disproportionate effect on some of the more coastal cities. But even they admitted that trying to determine the effect and the interplay between actual virus caused impacts as opposed to economic diversity causes is a very tricky thing to do. So this is kind of their predictions, but we're seeing some markets fare extremely well. Mostly in Texas. If you see in the bottom right, this is kind of a progressive ascending list of who's going to receive the least amount of impact, at least for 2020. So Austin, Dallas, Houston, top 3 markets in Dallas. So Houston, Texas, excuse me. So yeah, so they're going to come out of this a lot better than maybe say Las Vegas. So
maybe more diverse job sectors, like you said.
Yeah, that's definitely even more important now is which employment. And if you looked on the playbook, the first item was actually talking to your tenants, understanding their employment, really working with them, trying to be a team player with your tenants. And because some of these, I can tell you from looking at deals in these cities, some are more diverse than others. So it definitely pays to do your due diligence when you're looking to acquire properties. And I believe that is my last slide, and I'll hand it over to Vivek.
Thanks, James. Regarding the class of properties that might see the most impact, I might have a slide on that. So let's see. So hi everyone. This is the Grow Capitalist Town Hall, which was I think a few weeks back by Neil Bawa and Anna Myers. They did have a big broker from Texas and also Paul Peebles, who's on the lending side. Essentially, that focus was mostly on the multifamily apartment asset class. It had a lot of candid discussions on how operators are changing their approaches and why lenders are actually making their standards extremely strict. The main factors that were discussed was the impact to rent collections and the stricter lending standards, and essentially trying to find out what the multifamily real estate will look like going forward. One thing that we have to note is going into April, rent collections were looking extremely good across the board. To give some context, collections in March was one of the highest in recent years. This, along with low vacancies and attractive lending terms, really pushed prices high in the multifamily asset class. What happened after that was unprecedented. Starting from the 2nd or 3rd week of March, several states started to enforce the shelter in place, followed by a nationwide shutdown. As a result, over 10 million Americans lost jobs by the end of March. And I think by the end of April, that number is more than double to 20 million now. The next few slides give you an idea of a little bit depth of how rent collections look and also what the lending has changed. Next slide, Henry. Yeah, so you see, given the severe shock to the economy, the expectations for rents in April were extremely grim. Surprisingly, the numbers were much higher than the best estimates. About 2/3 of renters did not pay rent until the 5th of April. But by the 12th of that month, which you see in orange, that number jumped to 84%. And relative to March rents, the collection in April were about 93%. Which was not too bad given the extremely grim projections that we were expecting for April. When you slice the data in terms of which class of apartments had the best collections, Class A and Class B properties, which usually command the highest rents, performed slightly better than the Class C, which is predominantly workforce housing. This is probably because most of Class D tenants are employed in the service sector, which has been severely impacted by the shutdowns. In this next slide, we take a look at why this is the case and how May collections might look like. There seems to be some mixed feelings about how May rents will look like. When they become due in May, we are going to see more job losses. We are going to see higher unemployment, and the nation has been shut down for about a month as of today. The impact will be felt in May rent collections, but there are tailwinds. There's been a flood of stimulus both to the individuals and the small businesses and corporations. If you're a family of 4 and earn less than $75,000 a year, you get about $3,400 a month in stimulus, and this is on top of any unemployment benefits. This should probably help cover a few months of expenses, especially for the Class C and Class B tenants. But May rents will tell us the complete story, but that's definitely a tailwind. In addition to this, there's been $300 billion given to small businesses and corporations just to make sure that they don't fire anyone from their payroll. This is part of the Paycheck Protection Program, also called the PPP. And as recent as just a few hours ago, there was a Senate approval for an additional $310 billion for the PPP program. That should help May rents significantly because that would prevent small businesses from taking people off payroll. In the next few slides, let's focus a little bit on what's happening in the commercial lending side. Commercial lending side is essentially divided into 4 aspects. The blue is what's called agency lending. This is what Fannie and Freddie securitize and sell. Bridge loans are essentially something that are done by local community banks or even big banks. CMBS and life insurance loans are also a part of the commercial lending space. But the reason to focus on why commercial lending is changing and how it might be changing is because the lender is the biggest investor in any property, and they provide capital, which is ultimately the lifeblood of real estate. Agency lending has seen significant pullback in terms of their leverage numbers and also having to bring to the table 12 to 18 months of principal, interest, tax, and insurance reserves at closing. So this significantly increases the amount of money that is part of the equity raise, which essentially reduces the IRR a little bit. Bridge loans have seen a liquidity issue. In a few scenarios, we have heard that the lender could not fund the project at the end of closing, in which case the earnest money that the buyer had deposited completely vanished. CMBS and life insurance loans, as you see on the slide, have completely been shut down. Only in rare cases are any fundings happening, but that space is really taking a lot of beating, despite the fact that the Fed bought up a lot of CMBS securities, I think starting or mid of March. Despite all this, interest rates are really low and refinances are attractive right now, which is something that I want to focus on the next slide, coming to residential lending. On the residential side, we've seen some tightening as well. One of the nation's biggest banks, Chase, I think it's the 4th largest lender, has increased its lending requirements to have a minimum of 20% down and a 700 credit score for new loans. As seen in previous recessions, Chase has completely stopped accepting any home equity loans, and many other banks might follow suit if the economic situation continues the way it is right now. Wells Fargo has taken a some steps in the jumbo mortgages department, where those loans are essentially higher than what Fannie and Freddie can securitize. So they are only going to refinance customers who can hold $250,000 in liquid assets with the bank. Otherwise, there's no refinance happening with Wells Fargo. Another fact that we have to take into account is the forbearance. What that means is you can postpone or put a pause on your mortgage payments for a few months, and that figure has increased from a little below 4% to almost 6%. This might be indicating some early signs of trouble in the residential side, but only time will tell how different markets perform. But there is some discussions that markets exposed to tourism, retail, and more recently oil can take a larger hit than other markets. Next slide, Henry. So what's the outlook, at least in the short to medium term, for real estate? Some of the better performers might be assets like self-storage, where people people would not remove their stored items at this point because they can't even get out of their homes for non-essential activities. Apartments might do well given the stimulus package and the amount of money that is flowing into individuals and small businesses. And it is also an essential expense for most people. Mobile home parks, again, something that might do well during this downturn. Data centers, unsurprisingly, because most of what we do today is online, whether it's calling or meeting or working, it's completely happening through the internet, and data centers are going to do well. What's not looking so good is the hotel, restaurant, and non-essential retail space, which is either your furniture stores or other kind of non-essential shops which people are not really going to. Casinos are, again, something that have been shut down for at least 3 to 4 weeks. They might not do in the short term, or they might not do well in the short term. So that's pretty much what I had. Henry, you can go on to, I think, Vujay has the next slide.
All right. Okay. So the webinar I listed is one by Elisa, Zhang, and Cody, Touchette. Elisa is an operator. She's involved in many different projects. And Cody, Touchette, he owns his own mortgage lending company. He's an active investor himself as well. So so we need to understand the mortgage rate and what happened recently. So this is a graph I got not from them, but from a different website. So this shows the mortgage rate for the past 6 months. So you can see in the beginning, the left side, it was kind of like 3.7-ish, and it kind of started to drop down. And then in around March, there was a big spike, right? And then it went back down to the current level, which is just about 3.3%. So it's around March, if you remember, that's when all this coronavirus got really serious, and government, they gave 0% interest, and all this crisis was happening. First, what happened? So there was a lot of volatility in that area, and I was looking at the mortgage rate at that time, and I was thinking, what if the Feds are lowering their interest rate? Why is the mortgage rate actually going up in that time? And the thing is, the Feds lowering the interest rate is more affecting how the banks are lending money to each other. It doesn't really directly affect the mortgage market, but what really helped was the Feds buying, kind of guaranteeing that they're buying the mortgage-backed securities. That really kind of eased up the local banks and the lenders to give out mortgages, and that actually led to the stabilization of the mortgage rate. Next slide. So the mortgage market, you need to understand, it takes time for the loan to be processed, and they're limited by the underwriters and appraisers. And the mortgage companies do take risks when it's volatile, meaning if a lot of people want to do refinance, if they want to go into forbearance, it decreases the value of our servicing, which is like the kind of like you can think of as a profit that the mortgage companies get. So taking all that into consideration, when the mortgage initially in March, all that led to increasing mortgage rate, but eventually the Fed stepping in, that led to stabilize the mortgage market. So Cody is saying that it's really good opportunity for everyone to refinance their mortgage at this time. He's recommending getting a 30-year fix and use a extra money that you save to pay off other loans, because it's amazing that we're having such a low rate. And because the government is going to continue to back this program, we'll probably continue to see the low rate for some time now. And jumbo loans are actually not included because the feds are only supporting conventional loans. But jumbo loans are entirely backed by private lenders, so it might be hard to refinance jumbo loans and get new jumbo loans right now. Next slide. So some of the lending guidelines, I think Vivek mentioned, like Cody mentioned, that Chase is one of the national banks. Again, a minimum 700 credit score, 20% equity. A lot of companies that offer jumbo loans have pulled back them out. And then FHA's, USAID, VA loans have tightened up their criteria as well. So 620 to 659 minimum credit score. You gotta have adequate residual income. You gotta prove that you have 6 months reserve, below 45% debt income ratio. And for self-employed people out there, need to show about 12 months reserve or expect about 25% haircut on your income. So the way I interpret this 25% haircut is that, let's say when the underwriter is going over your application, if you say you earn 100K per year, they might actually write down a 75K per year to reflect to be more conservative. So expect that to happen. Okay, next slide. So a little bit the forbearance, as Vivek mentioned, is a temporary suspension of payments. So you could, be on forbearance for 3 months, but the amount that you postpone needs to be paid back after 3 months. It doesn't get added to the end of your loans. You may keep on extending every 3 months until you reach a max of 12 months, but at the end, you need to pay that all back. Or you can do loan modification, but there's going to be a lot of strict criteria at the end. Portfolio loans may follow different guidelines depending on the lender. So Cody's recommendation is that if you don't need a forbearance, do not take it. It will just complicate things. And also from the ethical point of view, this program is for people who really need it. It's better not to take it if you don't need it. And then when you're on the forbearance, it will show up on your credit report, but it's not going to affect your credit score during that forbearance duration, as long as all the loans are paid off at the end. And then let's say you have 3 investment properties. If one property is under forbearance, you cannot refinance the other properties. So if there's like a great mortgage rate, interest rate, you cannot refinance them as long as that one property is under forbearance. So that's something to think about for investors. Next slide. So they kind of, towards the end, they talk a little bit about single house market, and then Boyd will talk about that more in the future. But from Cody's perspective, so this is just his company, him looking at, it's not the whole national view, but from the activities he's seen a lot of demands for pre-approval letters. So there's still a lot of activity out there. He's not seeing purchase volumes going down yet. So it feels like it's very different from 2008. Right now, homeowners have better credit, better income, have enough equity. So market's kind of is holding steady right now. But it's uncertain what will happen if the unemployment situation continues. Next slide. And then this is they ended the webinar with this slide showing that since 1975 to 2020, overall the average the housing price has gone up 5%. In 2008 there was a deep dive there, but eventually kind of caught up. So it kind of ended the webinar in a positive note. But again, it's hard to tell what will happen if this situation just gets prolonged. Okay, that's it.
Thank you, Vijay. So I think I'll skip my charts. I think Vijay and Vivek already has covered a lot of the requirements for financing. I'll summarize it in one sentence would be, it would require a lot higher reserve for any kind of commercial lending, for multifamily, for example. So it's definitely making it a little harder to make an acquisition right now. It might not be a bad thing. We'll kind of have to see if the market deflates and maybe jump back in, playing offense when the time comes. This is also about valuation. Again, I think we can talk about, this is purely projection at this point. So I'll actually hold on to this chart and maybe we can explain in the future presentation, because I think we have some really good things we want to talk about, which is more of the residential side, which I think some of our audience care about. So I think, Boet, you want to take us through your slides?
Oh, thank you, Henry. So I just want to give you a quick summary about those those few articles about the impact of this virus on the housing market. I think they are mainly on the residential market. So next slide. Okay, so although this article they are published 1 week or 10 days ago, but everything about this virus changes every day, changes quickly every day or every hour. Interesting. In this article, they mention about 83,000 deaths worldwide. But today I checked, it's not 83,000 anymore, but 175,000. And then they said that the unemployment in America is around 10 million, but today I checked it's more than 22 million. So kind of wow, change quickly. So second thing, they're talking about the web traffic to those real estate portals. Zero rent Redfin. They said that it dropped 40%. So this part is kind of surprised me, because I'm thinking, people, they are at home, they're supposed to have more time to check on internet to see the house. So if that dropped that much, almost 40%, is that means people, they have less interest to buy and sell, this moment. So another thing is talking about the listing, the new listing drop as much as 70%. But of course, it depends on the city. Some of the city actually we discussed in the last online meeting 2 weeks ago. Some of the city they are they're a huge number, but some of the city is around 20-something%. So, and also because of less listing and less people willing to buy, the mortgage application drop around 18%. So it's normal. So jump to next slide. Okay, this one they said that the impact of different cities is different, but of course it's true. So if you look at those cities in red color, of course they have more impact, and then those cities, those areas in the Midwest, they have less impact from this virus. So this simple. Just move to the next one. Okay, this one I can spend a little bit more time on this one. They said how about those foreclosure happened in 2008? Is it going to have something similar happen this year, next year? So the government have implemented some policy to allow some delay or reduce a mortgage payment to prevent the foreclosure and also prevent the falling of the housing market, just like that happened in 2008. But will the mortgage lender have big trouble because of missing mortgage payment? If they do not have much cash, their financially may not be strong enough to keep their business running. So this part is kind of a big uncertainty to the market. So let's move to the next one. This one is talking about how about the new home market. So of course, because of the stay-home order, some new construction, of course, they will be delayed. Not only because of the worker are not willing to or not able to go to work, but also the government inspector, they may not able to do the inspection to issue the certificate of occupancy. So that's why it's normal to assume that. And the good news is that most builder now their confidence level is still high. So when the market, when the outbreak becomes it's gone, then they are willing to build more house. So here in Seattle, actually my coaching team they have let me see, 5 or 6 townhomes closing this month in new construction. So surprised me, none of them was delayed. So all of them closing successfully this month. And also this afternoon, I spoke with a local builder. He did mention that he's kind of, although for long term the confidence level is high, but he's kind of worried about the short term market this year or next year. So his strategy is at this moment try to keep as much as capital as possible, not willing to spend big money on development. and looking for the opportunity, for example, after the summer, to see if the market will drop a little bit, then he may consider to start, start some project after summer. So, okay, let's move to the next one. Next, okay, this one is about how about the spring home buying season. So traditionally, normally, if the inventory is low and now the listing is not much listing, so inventory is not that high, so demand is still high, and also the interest rate is low too. So the market normally should be hot, but because of the uncertainty of the mortgage industry, for those the impact of the delay or reduced mortgage payment. So will those mortgage lenders have enough capital to lend to potential home buyers is a big question. And this month, actually, I spoke with some local lender in Seattle area. So I should say most of them, they are more conservative. So, but they probably will, they actually ask for more requirement. Actually, you see some of the slide before, they ask for more, requirement to borrow money. And also they need more time to process. Some of them actually, they even mentioned that even for those transactions or is pending waiting for closing, they may not guarantee have enough capital for, for closing. So yeah, so that's it for my part.
And back to your point, I'm doing a refi for investment property, and I just spoke with the lender today, and she said, because I had my application in about almost a month and a half ago. They're still processing it, but they're not taking in new application right now. And this is with Luther Burbank, which I think one of the larger banks in the California, and they also have branches here in the Seattle area. So I think that's one lender, but I'm wondering how widespread this potential issue might be. It might be short term. I think what I spoke with the mortgage officer, she's saying they're still doing some loans, but they're definitely slowing down. They want to come because there's so much request for refi. They just try to process what they currently have. So I think there might be a bottleneck or a chokehold at this time, but they're still lending.
One interesting thing I heard was that the appraisal process, right? So a lot of homeowners, they don't want appraisers to come in, and appraisers are afraid to go into people's homes as well. So that actually caused a little bit of a shortage of the appraisal process.
Yeah, go ahead.
I was saying that that's the exact problem I had, and so the appraiser decided to just do an exterior appraisal. So I'm waiting to see what the appraisal report is going to look like.
I just had my appraisal, like a appraisal finished. So basically he drove by without telling me, just look at the exterior, and then also he look at some pictures online, and then he did a appraisal last year for me. So he basically see I upgraded some like interior, so he gave me a higher evaluation.
Oh, that's great.
Yeah.
So Yan, actually, last week I talked. I spoke with a appraiser last week, and then he actually told me that he no longer doing the real site appraisal anymore. So everything is on in the computer.
Yeah. I think he just quickly drove by. He didn't even say hello to me, so I didn't even know. But most of the research is done online, I think.
Yeah. What I've been hearing that some of the loans might close and then they do an appraisal like 2 or 3 months later, just to make sure that people feel safe. So they do a conservative appraisal without having to come to your property. But after the loan closes, they want to make sure that the loan is not over leveraged. So they would still want to do a full appraisal. That's something that some lenders are doing right now.
Oh, one more thing is I spoke with a local small builder, I think on Saturday. So normally, most of the time, he's looking for the profit margin around 30%. But now because of this virus outbreak, and then he said that he tried to get the profit margin more than 40% or 45% before he are willing to spend the money on the project. So they become more conservative and
right? I think they want a higher spread to make sure that they bake in all the different variables, right?
Yeah, so in case the market drop maybe 10%, they still 10 or 25%, he can still make some money. So
right, yeah, but seller are not right now currently, as I saw, not reducing price, not discounting their properties at least yet. So it'll be difficult for a flipper to find deal in this market, I think. Also, there's also less inventory as well. People are not looking necessary to sell. That's by the way, thank you, Blake, for doing this presentation.
thank you.
All right, so we are at the end, near the end of the presentation, and you will find these references for the presentation that we was based on, and yeah, more to that. And you will find this is recorded, and we'll have the presentation and the YouTube and the video if you have registered and you're here. So we'll be getting that as well. And also, just quickly to introduce, we will have future events coming up, and we have the next Coast to Coast meetup, which will plan to be on the 30th of April. We're hoping to have a guest speaker who's doing deals actively, syndicators, and also a lender to come share with us what they're seeing currently in the market and what they're doing to position for the next few months. And we are also doing what's called a co-investing meetup, which is basically member-based. We have just doing underwriting exercise together. We learn together. We analyze a deal together based on demographics, the sponsors, kind of what's the revenue model look like. So it's very heavily intense. We actually have another graduates from Multifamily U, and he has done quite a few projects since we done a boot camp together, and he's going to be a active sponsor or the operator. So he's going to share about his project on the 23rd, and then we're also planning to review one of Neil's project on the 28th, which he's talking about currently in Houston. So there's a lot of activity. We'll try to do and study as much as we can. Hopefully we do a good job. But on 23rd, Ang is going to be talking about his deal, and then 28th, the group will be doing more of detailed underwriting on the Neil's deal on the 28th. So these you can find out these dates and future events in our new Facebook page, which is right here, Coast to Coast Real Estate. I still have to create all those posts, but it will be there. And here's all the contact information. And thank you. I think Vivek's already posted information on the chat there as well. By the way, feel free to add your questions if you have any in the Q&A box, or raise your hand if you would like to ask your question. And also there will be future webinars by the main Multifamily University, which I think one on 401ks and investing in IRAs, and the other one talking more about the tax implications. So with that, I think that was the end of our presentations. Let's see if there's any questions. All right. By the way, I already saw a couple of questions there in the chat room. Thanks for that. Awesome. Okay. All right. Okay. I think
have a few questions in the Q&A on the chat box. I think a few of the panelists have answered that.
Awesome. Okay. All right. Let's see if I see anyone raising the hands yet. Nope. All right. I guess we have all the question and answer. I think we can call it a night, and we look forward to seeing you join our Facebook group and our future events coming up soon. All right. Good night, everybody.
Thank you.
Thank you all for coming, everybody. Appreciate it.
Thanks, everybody.
Let's go act on knowledge now.
Bye, everyone.